Ladies and gentlemen, good day and welcome to KDDL Limited Q2 FY21 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yashu Sabu, Chairman and Managing Director, KDDL, for his opening remarks. Thank you, and over to you, sir.
Thank you, and a very good afternoon and welcome to everyone for our Q2 FY21 earnings conference call. I hope you and everybody around you is safe and in good health. As usual, I am joined by my colleague, Mr. Sanjeev Mason, CFO of KDDL, and Mr. Raj Shekhar, CFO of Ethos, and SGA, our Investor Relations Advisors. And I hope everyone has had the chance to go through our updated investor presentation. During Q2 FY21, we witnessed an encouraging recovery in businesses as compared to the previous quarter. Our retail business, Ethos, has almost reached similar levels to last year, whereas our manufacturing business also continues to gain traction month after month. I'll start with a brief on financial performance on a consolidated basis for Q2 FY21. Consolidated total income for the quarter stood at 139 crores as compared to 158 crores in Q2 of last year, down 12% YOY. Consolidated gross profit for Q2 FY21 stood at 54 crores as compared to 68 crores in Q2 FY22, down 21%. Consolidated Q2 EBITDA stood at 17.4 crores as compared to EBITDA of 18.1 crores in Q2 of the last year, down only 4.4% YOY. We were largely able to contain the fall in EBITDA with strict control over expenses. Our Q2 FY21 EBITDA margin expanded by 110 basis points YOY to 12.5% on the back of various cost optimization initiatives. Consolidated Q2 FY21 profit after tax stood at 3.8 crore rupees as compared to a loss of 1.3 crore rupees in the same period last year. You must be aware that our financials are impacted by the application of Ind AS 116 accounting standard, which impacts EBITDA and PBT. Hence, our Ind AS 116 adjusted financials are also published in the investor presentation. I now come to the business-wise updates. Our manufacturing business comprises of watch components, precision engineering, and ornamental packaging business. In Q2 FY21, manufacturing business revenue stood at 34.6 crores as compared to rupees 49.4 crores previous year. The revenue share of watch components and precision engineering business was 71% and 27% respectively for the quarter. EBITDA for Q2 FY21 was rupees 5.3 crores as compared to EBITDA of 9.2 crores in the same period last year. Profit after tax in the quarter stood at 0.6 crores as compared to a profit of 4.2 crores in Q2 FY20. Revenue from watch components business stood at rupees 25 crores in the current quarter as compared to rupees 35.8 crores in previous year same quarter and 15.7 crores in Q1 of this year. Revenue from precision engineering business stood at 9.4 crores in Q2 as compared to 12.2 crores in Q2 and only 5 crores in Q1 of this fiscal year. During Q2 FY21, the revenue improved by more than 60% over Q1, but we are yet to reach the pre-COVID-19 levels of business operations. Due to the second wave of COVID-19 virus, especially in large Swiss watch export markets such as US and Europe, the improvement in demand for Swiss watches has been gradual. Nevertheless, Swiss watch exports are continuously improving and are expected to reach previous year levels by Q4. Some of our customers have deferred their orders, but we have not witnessed any significant cancellation of orders. Our order position for next few months is as per or better than our forecast, but a lot depends on the through sales of watches in the festive seasons in most of the important global markets between November and January. Our precision engineering business, eigen, witnessed a decent recovery in Q2, and its revenue improved from rupees 5 crores in Q1 to rupees 9.4 crores in Q2. This improved position is still lower than the revenues recorded in the previous year corresponding period. Some of the industrial sectors, especially aerospace and electronics, have been severely impacted due to COVID-19, but we expect that these sectors may reach normal levels by next year. We continue to witness an encouraging increase in the flow of inquiries and RFQs, both from domestic and export markets, from other segments such as auto ancillaries, industrial and instrumentation industries, also from consumer durables, and some of the segments and accounts which show healthy potential in the coming quarters. We also believe that the initiative of the government, Atmanirbhar Bharat, and increased budget allocations for defense sector will provide enhanced opportunities for our eigen business. We remain confident of achieving healthy revenue growth in the precision engineering business. Various cost initiatives taken by us during these last 6 to 8 months has helped us to lower our break-even point considerably. This is also evident from the fact that the company reported profit for the quarter despite the revenue being lower by nearly 30% compared to the previous year same period. We believe that with the normalization of market conditions, the profitability of the company will be healthier and stronger due to the cost rationalization measures. We expect the business operations of the manufacturing business to reach pre-COVID levels in the next 2 quarters. We continue to believe that prevailing situation will also create exciting new opportunities for the company as some of the weak players might exit the market. Briefly about Estima AG, our Swiss subsidiary. Our idea behind the acquisition of Estima AG was to expand our footprint in Swiss manufacturing. COVID-19 has increased the lead time to turn around this business, but we see encouraging signs all around. During this quarter, Estima reported a revenue of Swiss francs 342,000 and was at a break-even level for EBITDA on EBITDA basis. This is broadly in line with our internal plans and expectations. Estima reported a PBT loss of 69,000 Swiss francs during this quarter. Let me now discuss our watch retailing business, Ethos. It gives me immense pleasure to share with you that our watch retailing business is coming back on track with a strong performance in Q2. This is due to the strong foundation of the omni-channel strategy, exclusive brand tie-ups, the pan-India network, flagship stores, and a redoubled emphasis on after-sale service. We are optimistic that the momentum will continue to gain ground during Q3 and Q4 and give us results that are better than our original COVID forecasts. Let me now give you financial highlights of Ethos for Q2 of this fiscal year. Our billings for Q2 FY21 were rupees 120 crores as compared to 123 crores in Q2 of last year and 32 crores in Q1 of FY21. Thus, it means there is a huge improvement over Q1 and we are almost back to the previous year levels for the quarter. Of this, billings for exclusive brands for watches contributed nearly 32% and accounted for 44% of the total gross margin. Consolidated total income for Q2 FY21 stood at 108 crores as compared to 107 crores in Q2 FY20 and rupees 33 crores in Q1 FY21. Consolidated gross profit for Q2 FY21 stood at 31.5 crores as compared to 29.1 crores in previous year same quarter, a handsome growth of 8.5% on YOY basis. Gross profit margins expanded by nearly 200 basis points YOY to 29.3% in Q2 FY21 as compared to 27.3% in Q2 FY20. Consolidated Q2 FY21 EBITDA stood at 16.9 crores as compared to EBITDA of 10.8 crores in Q2 FY20, registering a growth of 56.3%. Consolidated profit after tax stood at 3.3 crores in Q2 of this year as compared to a loss of 2.8 crores in the same quarter of the previous fiscal year. Stock carrying months at the end of September 2020 was 7.9 months, again an improvement. We continue to work towards cost optimization in various ways. In store rationalization, the store count at the end of the quarter stood at 47 stores. In the current year, we opened one store each in Lucknow and Delhi, while we closed down 8 stores. With respect to cost optimization strategy, from our negotiation with the mall owners and real estate partners, we have been able to achieve a handsome reduction in rent and waiver at most of our stores, and we have also deferred various expenses which can be delayed in the medium term to prudently conserve cash. All of this can be seen as improvement in our expenses and in the bottom line. In our digital strategy, we continue to spend on marketing through digital mediums as we have witnessed continuous flow of visitors on our Ethos website. Online-led billings contributed nearly 46% of our H1 FY21 billings. Our pre-owned watch business, which we have launched recently through the website secondtimezone.com, has continued to pick up. We are ourselves in the learning phase for this business, and with our excellent after-sales service infrastructure, backed by strong technicians and a watch expert team, we are confident to steadily build the business of pre-owned watches. Coming back to company matters, I would like to add that the Board of Directors have also approved a fundraising plan in KDDL by way of a rights issue. The fundraise has been approved up to an amount of rupees 30 crores by way of a rights issue, and this is intended to be utilized towards growth and development of the company as we see several exciting new growth opportunities likely to come before the company in the quarters to come. I now welcome your questions and participation.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dipen Shankar from Trustline PMS. Please go ahead.
Good evening, sir. Thanks a lot. Hi, sir. Good evening and thanks a lot for the opportunity and congrats for the Ethos best performance. So just wanted to understand this strong Ethos performance, will it be reflected by strong demand for our product or we are seeing increase in market share due to unorganized players going down or imports coming down? So how are we expecting this demand to be sustained over next few quarters?
Dipen, if you have other questions, why don't you ask them all right now and we can answer them all?
Yeah, sure. And also I just wanted to understand the contribution of exclusive brands during the current quarter and as compared with the last year.
Okay. So as far as sustaining concerned, I think it's a little bit all factors. What we see is that there is a revival of demand. I think people have got a bit sick of just sitting at home, so there is a revival of demand. It is a festival season, but don't forget it is also the wedding season. People are traveling less, so we assume that they may be spending less on travel, but they won't be cutting down on purchases. I think we are seeing a combination of this, together with the fact that some of the weaker players may not have the kind of digital reach that we have. So many customers who may not be willing to visit the stores are still able to purchase using our digital platform. It is partly that. Imports has no real bearing on this because most of the watches that we sell, in fact all the watches that we sell are imported. And while there were some months and there was some supply disruption, but more or less it is now being normalized. So I don't think there is any disruption on imports as such. But what I can say is that since the import has not revived as much as our sale has revived, it is a strong indication that we have gained market share as compared to our competitors.
Okay.
I believe that the demand will be sustained. The festive and the wedding season will continue up to January. And of course, a lot depends always on this quarter 3. And so far, the indications are that it should be as per our expectations or a little better.
Okay. And on exclusive brands?
On exclusive brands, in quarter 2 of this year, 32% of the revenue was accounted for by the house brands, and in the previous year, it was 22%.
Oh, okay. So this is one of the main reasons for gross profit expansion also.
Yes, it is.
Okay. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Hi Yashowji, wish you happy New Year. Yeah.
Happy New Year.
So one question is more on the manufacturing side. If I heard you say that the orders got deferred a little bit, and that it seems like the next few months or next quarter is going to look good. Can you give us some color? Was there some customers who just stopped, or are they all customers giving you similar feedback that they've pushed out the orders because the global watch market is soft? And how are you? Are there alternate products that are taking up the capacity there? And do you kind of think by the March quarter you'll come back to the production levels or the revenue numbers on the manufacturing side that you saw at a high level that you saw a year ago?
So, Jeetu, let me just try to remember what you started with. Yeah. See, the deferment has not really been because of demand issues. I think a deferment has been because of lockdowns that happened. So it's a sort of a chain effect in the supply chain, right? So let us say March, April, May, China lockdown. So many of the components come from China. Then April, May, June, July, more or less Switzerland was semi-lockdown. 2 months it was completely locked down, then it started, then they had their holidays. So knowing all this, some of the orders were postponed. Now, what was already sort of in the pipeline, we didn't accept the deferment. So they deferred the deliveries of July, August, September by a little bit. The other deferment which happened was typically orders which should come in the month of August, September, immediately after the holidays, the Swiss holidays, they got deferred to, let's say, October, November, and now we start seeing them coming in. The same is actually said for the domestic demand as well. So it got deferred and now we see it coming in. So it is much more to do with the supply chain. I think demand Overall, of course, it is less, but I think China is picking up. Most of the other markets are also picking up. So, for example, in September, the Swiss watch exports were down by only 10% compared to last year. And October, I presume the decline will be even less. So we can say that demand is going to be back to normal, and the deferments will also iron out by December or so this year.
Okay. And you think
in the precision engineering business, again, there were deferments from large companies like ABB and the auto component companies. They are deferred. Similarly, on the aerospace sector, we have very big customer on the aerospace sector, and aerospace, you know what the situation was. Everything was deferred. But now we see a revival of all of this coming. So over the next 3 to 4 months, we expect things to normalize.
Okay. The second question is your rights issue. Is that money more needed at the retail side as your contribution to the company as equity, or is it more needed at the manufacturing side?
It is more needed in the retail business. We see some exciting opportunities coming up on the retail side. Some of them you will hear over the next couple of weeks and months, as we are in the process of finalizing some, and others we believe are in the pipeline and will turn up once the COVID situation normalizes. We had expected COVID to normalize by August, September, and that is why we had earlier planned that the opportunities may start coming up already by September, October. Now, as we know, Europe has gone into a second wave, and we believe things would normalize now only by February, March, and we need to be ready for when the opportunities come up then. But clearly, to answer your question, the opportunities are much more in retail than in the manufacturing.
Okay, and when you said opportunities, are we talking about acquisitions? Are we talking about new alliances? Just give us some color without...
It's about new alliances with some new brands. It is about increased alliances, strategic alliances with existing brands. We are pursuing the acquisition of 1 or 2 existing distribution arrangements here. So, unfortunately, we are not able to travel. Many of these require a face-to-face discussion. That's why I'm saying that some of this may actually happen when travel gets okayed, when the overseas international representatives are able to visit us and we are able to visit them. A lot is therefore slated to happen in the months February, March, April.
Okay. Last question on the retail side. Can you give us some color on, what percentage of business was e-sourced, and are there some stores that are working, not working? Are you planning to cut down some stores, add some stores, the normal rationalization that happens? Just give us some thought process on that as well, please.
So I think the e-led billings, the e-commerce-led or the internet-led billings were more than 50% during the last quarter, which is very heavy.
Okay.
Obviously, it was because in quarter 2, many stores were still closed. Bombay was closed until I think August almost, or the middle of August. Chennai was closed even later. However, now all stores are open, except of course the 8 stores that we closed down. Delhi duty free, which is one of our best performing stores, is still not active. We are still running it on a pure revenue share basis, but as you can imagine, the flights, there are hardly any regular flights, so it's more for namesake. It's continuing. But other than that, all stores are operational. We will, as I mentioned in the speech, we have started 2 stores, one in Delhi, Vegas Mall, and one in Lucknow. And we will start a new store in Mumbai, very close to where you are in the Maker Max, the new mall coming up in BKC. That is expected to start in January 2021. As of now, there are no firm closures in mind, but we are considering a possible closure of 1 or 2 more stores, which we will consider the performance during the season period. And if it is not something extraordinary, we may select them for closure.
Okay. And one final piece. Where are we on inventories? Are we, is that number contained or have you added?
We are on September, we closed at about 7.9 months of inventory. Again, it's a little bit higher, but that's also because the way we calculate it, and if the sales is low, then the inventory in terms of number of months, it becomes higher. But overall, I mean, again, I say this all the time, globally, this is much lower than the global standard. Global standard for luxury watch retail is 11 to 12 months of inventory. We are at 7.9 months. Our long-term goal remains to bring this down to about 6 months.
Okay, super. Thank you, sir. All the best.
Thank you, Jitu. Thank you.
Thank you. The next question is from the line of Pratik Podar from KBC and Associates. Please go ahead.
Yeah, hi. So could you just talk a bit about September growth rates, exit rates? Because I remember last quarter you talked about pent-up demand. In the sense, so could you just talk a bit about how was September growth rate versus last year?
Okay, Pratik, I'm just pulling that out. They're pulling that out. Do you have any other questions?
Yeah. Also, if you can talk about how has the festive season sales gone and the cost rationalization efforts, how sustainable it is. It looks like you have just, I mean, in the sense you said in the opening remarks, we have deferred costs. Is it permanent or it is temporary? Lastly, also, sir, there is an FD. I mean, you're asking for, you've gone on for a circular where you're asking for fixed deposit from shareholders. Why do we need that is the last question.
Okay. Let me answer the last question. We have FDs since ever. We have FDs from shareholders, and I think the announcement is a regular announcement that happens after every AGM. Shekhar, correct? Yeah. So that's a regular announcement that happens both in ESOPs as well as in KDDL. As far as the cost rationalization is concerned, there are two aspects to it. One of them was what you could say temporary, whether it was in terms of, some salary cuts or deferment of some bonuses. As of last month, as of this month, all salary cuts have been restored. I think our team has worked extremely hard during this time to deliver the results under very, very trying conditions. Sometimes half the store staff down with COVID infection, interruptions, and so on. So we felt that with the results and the performance getting back on track, so we've restored all the salary cuts. So on the salary front, whatever cost reduction was happening, that's now back to normal, except of course where there are store closures. So where there are store closures, there the cost reductions are permanent. On rent, most of the rental relief came in the first two quarters, quarter one and quarter two. Of course, because during this period, most of the malls were closed, especially in quarter one. Quarter three, most malls are operating normally, so rents are also back to normal. Nonetheless, I think there will be a cost rationalization which you will see, but of course it cannot be at the same level as is reflected in H1 results. September exit rate, September we had a billing of, what was the exit rate? Growth? No, it wasn't sales in billing in September. I think the question is that in the quarter there's also pent-up demand.
No, only that. That's why only September over September billings.
Yeah. So we just give it. So the billings in September was about 40 crores. So
last year?
Pretty equitable, yeah.
And last year also it was the same, sir?
Last year was about 47.
Okay, so you're down roughly around 12-13%.
Correct.
Got it. And sir, how has the festive been for you?
So the festive season, obviously, we are hopeful that quarter three will be significantly better than quarter two. So far, it seems to be. Festive season is a misnomer sometimes in our business because people say that Diwali pe log kharidte hain. Actually, Diwali pe kharidte hain, but a lot of the purchase is related to weddings and anniversaries and celebrations, which also tend to bunch up during this quarter. And the wedding season, as you know, lasts up to December and goes into January as well. So really a lot depends on the next 6 weeks. We are seeing positive, we can say with confidence that it will be better than Q2. How will it compare with the same quarter of last year? That remains to be seen. Last year we had a very strong quarter 3 after a weak quarter 2. Right? If we can get anything close to that, I would be very, very, very happy indeed.
Got it. And sir, just lastly, just double checking, this FD is just an announcement. It's not that you want to raise funds as of now via that route. Right? I'm just double checking.
It's just an announcement. It's just an announcement.
Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Amy Truesdale from Jupiter Asset Management. Please go ahead.
Hi there. Thanks for taking my question. Just a quick one from me, actually. We've heard in the press before discussing this zero GST for overseas visitors. Just would be great to get your thoughts on whether you think that's a likely development, and if there are any other tax or duty related developments that you think we should be aware of.
Amy, could you repeat the question, please?
Yeah, sure. Zero GST for overseas visitors. Do you think, does that sound like a likely development? And are there any other tax or duty related developments that we should be aware of?
Okay. Just give me a minute, please.
Sure.
Amy, it is true there was some talk about creating a structure for allowing relief from GST for overseas visitors. We haven't heard anything further, and we don't believe there is anything in the pipeline that will show up early. There are no other new developments on GST for the moment. It remains stable where it was.
Great, thank you.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Isha Savla from Arya Securities. Please go ahead.
Hello.
Hello, Isha.
Yeah, thanks for the opportunity, sir. Sir, I wanted to know that what could be the sustainable EBITDA margin in our manufacturing business going forward?
Okay. Do you have any other questions, Isha?
Yes, sir. I have one more question. That can you please give some idea about the current demand situation of this market? And also, I wanted to know that what digital initiatives the company is taking on the e-commerce side. That's it from my end.
Okay. Isha, on the first question about EBITDA margin, the current margin is about 15%. We believe sustainable margins are 18% plus, and we should recover to that in the next couple of quarters. Current demand, you were talking about current demand in the Swiss market?
Yes, sir.
So, as I mentioned to you, our demand really comes from how Swiss watch exports behave. And Swiss watch exports are up to about 90% of their previous year levels. So we believe that the demand will continue to recover as it has recovered over the last couple of months. And we expect quarter 4 to pretty much be equal or better to last year's quarter 4 in terms of demand from Switzerland. And your last point was regarding the e-commerce initiatives. I would recommend you to please look at the investor presentation where this is shown. Briefly, I can tell you we work on an omni-channel platform. Through digital marketing, we create leads. The leads come to our call center. They are first tracked there. The first level of interaction is done with customers there. And finally, the customers are encouraged to visit the stores closest to them where they can physically see the watch, and the sales are then finalized at the store level. So it's an omni-channel platform where the physical stores and the digital platform work hand in hand to give an optimal customer experience.
Okay, sir. Thank you. That will help us.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Lalaram Singh, an individual investor. Please go ahead.
Hello, good evening, sir, and all other gentlemen.
Good evening. Good evening, Lalaram ji. How are you?
I'm doing good. I hope you are doing good too, sir. Sure. So my first question is that in the precision engineering business, around a couple of years back, the momentum was good. We were targeting around 100 crore revenue run rate from that business. However, things have sort of become sluggish, and we have got stuck at maybe sub 40 crores, I think. So do you want to comment on what exactly is happening there, and what are the hurdles we are facing, and any particular timeline where do you think the growth momentum can again come back? So just I want a comments there. My second question would be on the ethos. I suppose that we have bought back around 6 crore worth of shares from one of the investors. So any further buyback because of certain put options in the SHA? That is the second question. And the third question would be that ethos performance was at par with previous quarter last year, while I think the square feet must be lower, I believe, and even the timings were lower. So do you want to comment on what was the like-to-like growth on a store basis, assuming that?
Can you repeat the third question? Can you please repeat the third question?
The third question is that I believe that in this quarter, compared to the previous quarter in the corresponding year, the number of stores which were open would be less, or in terms of square feet also. So do you want to share any number in terms of like-to-like growth or a per square feet basis sales per square feet basis growth? Could I get across my point?
Just give me a minute. So, Lalaram, on the same store growth, it's been about -6%.
Okay.
In Q2.
Okay.
There is a certain complexity that comes about the way we calculate, because we consider same store growth only for stores which have operated over 12 months. Whereas there are some stores which were, let's say, which opened in September or October, and we are seeing a very good growth over there, but we are still not counting it as same store growth because a full 12-month year, a full fiscal year they haven't spent. So they will come only next year. But clearly you have seen that despite fewer stores, our billing has been nearly the same, and our margin has actually been better. So I think what your hunch is probably correct over there.
Okay.
As far as the ethos put options are concerned, there were several shareholders which had put options. All but these which have now been exercised, which have been disclosed, which you know about, these are the only put options, and there are no other put options. For Eigen Engineering Performance, I'm going to pass the mic to Sanjeev to explain the situation there.
Lalaram, I will request you if you can just repeat your question related to
Yes, sir. Sir, my question was that couple of years back, we were growing handsomely in IGEN. Also, we were sort of expecting to hit the first target was to hit 100 crores of revenues. However, it seems that we have got stuck at around, I'm not sure, but sub 50 crore revenue run rate there. So just wanted to understand what exactly is happening. Is it that we are pivoting to a new customer segment which is taking more time in terms of approvals, or is it something else? So just wanted to get some color on IGEN, and when can we expect that growth trajectory to again come back? Because I believe IGEN has a much bigger addressable market compared to our Swiss watch component business. So may I just understand, what are the developments which are happening there? What has caused this growth momentum to sort of stagnate, and when do we expect it to again come back on the growth runway and hit our, say, 100 crore target?
Okay. Yes, I have understood your question. What you have shared is right, that when we started focusing on the IGEN business, the revenue potential, the opportunities were much, much bigger compared to our watch component segment. And our aggressive targets of the revenue numbers were substantially higher. And during this process, especially during the current year, due to COVID, many sectors and the many industries have been badly affected. But we still continue to believe that the growth in IGEN will be significantly higher compared to the watch component industry. And those numbers are already, you have seen in the first half of the year, where we recovered almost 100% from the quarter 1 to quarter 2 in IGEN. And we continue to believe that in the coming quarters also this growth slowly will be there. Maybe this year's numbers broadly will be somewhat similar to the previous last year numbers, but with the coming years, still the opportunities, segments, customers, all those are very promising. And during I will say the last few quarters, we have also been rationalizing the customers and some of the segments, whether we want to be focusing into that or not. Especially the segments like the electronic segment, where our margins were lower. We are consciously bringing our market share or the revenue, we are not focusing much into that. The high profitable or the high margin segments, we gradually want to move into that, but it will not happen overnight. The original thinking and the strategy behind IGEN still remains there. I will say that many of the developments in the last few quarters, whether this of Atmanirbhar Abhiyan, which the government has initiated, or the defense-related sourcing, which the government is spending a lot of money into that, and even the promotion of the MSME sector for many other industries. We see a good flow of inquiries from the overseas customers, where earlier the customers were hesitant to respond, and even their time to respond is also much faster now. So we remain strongly confident of achieving the high growth revenues in this number. But more than the revenue growth, we are targeting for the bottom line and the correcting the margins into that. So there may be some course corrections which may be happening, but overall strategy is still the same.
Okay. So, sir, within the current setup which we have for IGEN, what is the sort of overall revenue potential, or what is the capacity utilization which we are currently running at? So to understand the revenue potential of the current setup.
It becomes little difficult to talk about the capacity utilization, but if the broad ballpark numbers, if you want to see the revenue, definitely it is possible to take 60-70 crores with the existing investment.
60 to 70 crores.
Yeah.
Okay.
And all depends upon the type of component which we customize and make for the specific segments of the customer. It is not a ready-made product where the average prices are things. And as we are moving up the value chain for some of the complex parts and the components where the entry barriers are high, that will help us in improving the margin. But the capacity utilization is something difficult to arrive for this industry.
Agreed. Sir, we had seen that galvanizing line was set up, so all that was supposed to help our margins also. So are we able to utilize all that, or we are still filling that orders and capacities? in the process of doing that?
2/3 of that capacity is being used, and we are scouting for the more business for that. And that's one of the USP we have compared to the competition.
Yeah. Sir, we just want to see that, the growth momentum which was there, because it seems to be a promising area. Also, there is a much larger market. So just waiting for those numbers to sort of trickle down. So one last question, if I can put in, is can you also help us understand which are the focus industries right now for hygiene? You're saying electrical is very competitive, low margin. So I understand aerospace is where you're focusing on. Apart from that, what are the top 3 sectors which we are trying to break into?
I can see that one definitely about the aerospace and defense. Another is the auto segment, also the electrical vehicles. That's another major move in the industry shift which is happening, and we are fast moving in that for supplying components for the electrical vehicles. And for the consumer durables, also the PLI schemes which the government has announced, a lot of manufacturing will be coming here which require the high precision components.
Okay. Got it. Sure, sir. We'll wait for the coming quarters.
Thank you.
So thank you.
Thank you, Jitu. Lala, I'm sorry.
Sure, yes, sir. Thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Amit Shah from Vision Capital. Please go ahead.
Hi, sir. I just have one question. What is the total debt and total debt separately in our manufacturing and retail business?
Okay, just let me tell you. Current debt in the retail business is 45 crores, and in the manufacturing business is 76 crores.
Okay, and cost of debt?
In the manufacturing, it's about between 10 and 10.5%, and in retail, it's about 11%.
Okay. Thank you, sir.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Saurabh Ginodia from Smiths Limited. Please go ahead.
Hello. Yeah, sir. Thank you for the opportunity. Sir, in the opening comments, you mentioned that we have taken certain cost reduction measures by the help of which we have been able to reduce the break-even sales. So just wanted to get an understanding at what level of monthly sales do we break even in Ethos now?
Well, Saurabh, this depends on whether you are looking at the cost structure now or steady state. Because the cost structure in Q2 obviously was lower because of the rental reliefs and other cost rationalization. Some of it is permanent, some of it will not be permanent. But if I were to understand the spirit of your question, you're saying that in a steady state, what is the kind of...
Yeah, in a steady state, in a normal scenario.
What is the kind of... scenario. Yeah. Just give me a moment. Just give you an estimate there. $44 per month. So that would be at about 40 crores per month.
Okay, and if one would have looked into this number before cost reduction, how much was that?
This is at steady state. This is at steady state once the cost reductions, they have, the new stores have come up, which are now in the pipeline and so on. Earlier also, it was probably a little bit higher, maybe around 40, 45, but now it's down to about 40. Maybe it's going to be a little less, depending on, which stores perform how, but probably a little bit lower than 40 crores now. And it was a little higher than 40 crores 12 months ago.
Okay, sir. Thanks for that. And second question was with respect to the contribution from pre-owned watches. If you can help me with the number for Q2 and the first half for this financial year.
Yeah, the sales of pre-owned watches in Q2, just 1 minute. While Shekhar is bringing out the number, what I'd like you to appreciate is that pre-owned watches, the sale of pre-owned watches depends on the purchase of pre-owned watches. And the purchase of pre-owned watches is done domestically from consumers and customers. So during the lockdown, one of our great impediments was not being able to connect customers to buy watches. If you can't buy watches, there's nothing to sell. You know what I mean? So now with the lockdown open, of course, it's becoming much more active. 3.7 crores for the first half. So the pre-owned watch sale for the first half of the year was 3.7 crores.
Okay, understood.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Lala Ram Singh, an individual investor. Please go ahead.
Hello, sir. My question is on the pre-owned business. So you want to continue this as a business where you will be buying the stock and then sell it? You don't want to convert it into a marketplace model?
No, it can be converted. Buying doesn't always mean that you have to buy it yourself, but you have to do a connect and a contract with the customer. You have to be able to get hold of his watch. Even if you don't buy it, you have to see it that it's a genuine watch. You have to service it. So it cannot be a pure marketplace in the sense that I connect A to B.
Mm-hmm.
And I'm just taking a connection, margin for connection. The vital value that Ethos or Second Time Zone adds is the ability to check the watch, service it, get it into working condition, be in a position to offer a warranty on that, and of course, above all, to sort of warranty or guarantee that it is a genuine watch. So whether or not I actually buy the watch, I still have to get it and process it in my workshops before I can offer it.
Got it. So in this, in the current setup, are you paying all the money upfront when you buy from the buyer or the seller? Sorry.
Mostly yes. Right now, mostly yes.
Okay, got it. Got it.
Later on, I think once the business becomes sizable and we are able to spread it, we have in mind to work on a combination of outright purchase and where you actually don't buy the watch. We've done it in the past also, but at the moment it's just very important to be able to get hold of the watches.
Got it.
There are not enough watches. We are not able to buy enough watches because of constraints of lockdowns and customers not coming and so on. We are able to sell very easily whatever we have.
So saying selling is not a problem. That's what you're saying.
No.
Wow. So the follow-on question to this is that what I understand is typically, the collectors are the ones who try to upgrade. They sell the existing watch collection which they're not wearing, and then they sort of sell it to purchase a new watch. Or so in this case, there are always subgroups or WhatsApp groups which people who are sort of into this. They all have their own network. So do you think it's a challenge to parallelly sort of compete with them? Just your thoughts on that, because I don't understand this market pretty comprehensively.
I don't think it's a challenge. In every business, you will have groups and influencers and opinion groups and opinion makers and all of that. I don't think it's a competition to us. I think we have to complement it. The opinion makers don't have the means of servicing the watch and bringing it into an excellent watch condition, excellent condition.
Okay, got it. And when you price these watches, how do you think about what is the framework which you use in terms of is that X% gross margin you want to make on these watches? Because I mean, assuming that if you sell very quickly, then you can actually sort of price it at a much lower gross margin than what you're currently doing on new watches, and still make a decent return on capital. Is it correct?
I'm almost sure that's something which is confidential. What is our pricing strategy on that? But
okay.
And frankly, I'm not really very much into the pricing strategy of pre-owned watches. Even if it was, Lalaram, you'd appreciate that that's something which would be confidential.
Got it. And can I ask one question? Is that when you set up a listing price on second time zone, when the actual transaction happens, does it happen at that price, or generally from there, typically negotiation happens and actually ends up at a lower price than that? Can you comment on that or no?
I think it depends on watch to watch. If it's a watch that is in good demand, there's no negotiation possible. If there is a watch which is not in that much of a demand, but there is a customer who asks for a somewhat discount, we'll do it. I think normal market conditions prevail over there. Yes. Depends on demand and supply. Yeah.
Got it. And any plan on scaling this up by setting up a sort of a dedicated like a pre-owned watch store, or have you started to think about this business in more detailed manner, how to expand it, or it's still early days?
We have thought in enough detail, and there are developments happening. I can't really speak about it very openly right now because there are some things which we are finalizing, but there are very detailed and very, let's say, ambitious plans for this business.
And do we have a new sort of team which has been set up, or internal people were sort of allocated to this project?
Oh, there is a team for this. You can't do it. You can't build this business as a just on
offshoot of the.
No.
Got it, sir.
Thank you.
Thanks a lot, sir, and all the best.
Thank you. Thanks, Lala.
Thank you. The next question is from the line of Jagdeshwar Topo from Japa Investment Advisors. Please go ahead.
Yeah, thank you so much for the opportunity. Sir, I would just like to know how is your pricing power shaping up? Has it improved given the fact that competition probably has become less intensive, and also now you are on a platform, online platform, where you are selling almost 50% online. So specific is like earlier you were offering some kind of discount on let's say on your watches. So is that discount still there? So how is the situation in last 6 months? If you can explain about this.
Do you have any other questions?
I have one more question. This is relating to Rolex. We had heard you saying that there is a shortage of Rolex, and so how is the situation as far as the Rolex is concerned? And if there is still shortage, why can't we tie up with Rolex, let's say exclusively, and sell in India using online platform or offline also? These are my two questions.
Okay. So as far as discount is concerned, yes, we still have discounts. That's a characteristic in the market, pretty much across the globe. So we do have discounts. So that's as far as the first part of the question is concerned. Regarding the shortage of Rolex, see, Rolex is it is the most coveted and the most demanded brand in the world. So there's a shortage of Rolex worldwide. And Rolex doesn't do exclusive arrangements with anybody. Everybody who gets Rolex is very happy that they can get Rolex, whatever is allocated. So Rolex watches are in such a great demand that there is always a shortage of supply, and you have to ask for allocations and so on. Now, typically earlier this year, because of the lockdown in Switzerland, there was some disruption in the production schedule, and that created some shortages that were more than the normal. However, it has eased out, and now the shipments are coming regularly. So There is, of course, always a shortage of some specific models of Rolex, which are very much in demand. But for normal models of Rolex now, there is no great shortage.
That's it from my side, and all the best to you.
Thank you.
Thank you.
Thank you. As there are no further questions, I now hand the conference over to Mr. Yashash Shabu for closing comments.
Thank you everybody for joining the call, and I hope we've been able to answer your queries. In case of any further queries, please contact SGA, our investor relations partners. I thank you once again for joining this call and wish you a safe and healthy period ahead. Thank you very much again.
Thank you. Ladies and gentlemen, on behalf of KDDL Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.